Welcome to CMA Exam Academy. In this video lecture, we'll review liquidity ratios. You can find the corresponding reading material of this video lecture in your CMA Part-Two textbook, Section A, Topic 2. If you're ready, let's get started. Let's have a quick intro on financial ratios. Aside from the basic financial analysis techniques, such as vertical analysis or horizontal analysis, financial ratios or ratio analysis is probably the most commonly used tool in evaluating financial statements. But before digging in, let's start with defining what ratio is. A ratio is technically a mathematical representation of the relationship of two values or numbers. Ratios can be expressed in proportions, percentages, or fractions. Any two values or numbers can have a mathematical relationship. What makes financial ratio analysis different from an ordinary ratio? A financial ratio must be financially meaningful. The numbers to be compared or expressed as a ratio must be meaningfully related to each other to provide users with relevant information that they need. Different ratios cater to different users. Financial ratios provide users with information about a company's liquidity, leverage, activity, profitability, market valuation, and more. 1. For example, short-term creditors are more concerned with liquidity ratios of their debtors. 2. Long-term creditors are more likely interested in solvency or leverage ratios. 3. Also, generally existing shareholders and prospective investors tend to be more attracted to a company's profitability and market valuation. 4. Managers, however, is responsible in virtually all ratios, so that it will be favorably viewed by creditors, shareholders, and other potential business partners. That is, however, depends on a manager's level of authority. The higher the management position, the wider would be the manager's responsibility in these metrics. Based on IMA's Learning Outcome Statements, LOS, our discussion on financial ratios will be divided into 6 parts. Those topics are liquidity ratios, leverage or solvency ratios, activity ratios, profitability ratios, market ratios, and the general information about financial ratios. In this lecture, we will first discuss liquidity ratios. Liquidity ratios are ratios that measure the company's ability to pay short-term obligations or current liabilities as they fall due. In the introduction, I mentioned earlier that liquidity ratios are most important to short-term creditors. However, it should also be a concern for long-term creditors, shareholders, and other stakeholders. The reason is that a company cannot survive in the long term if it cannot even pay short-term obligations. Our lecture on liquidity will focus on 2 topics. First is the interpretation and computation of the different types of liquidity ratios. Second is the understanding of the changes in the components of liquidity and its impact on liquidity ratios. Let's get started. First, we need to learn how to interpret and calculate different types of liquidity ratios. The 5 general types of liquidity ratios are current ratios, quick ratio, or the acid test ratio, cash ratio, cash flow ratio, and the net working capital ratio. In this discussion, we will use the following problem. Liquidity Company has the following financial statement amounts as of December 31st, 2016. We will practice computing the current ratio, quick ratio, cash flow ratio, and the net working capital ratio using the information of Liquidity Company. Let's start with the most basic liquidity ratio, the current ratio. Current ratio means the proportion of current resources or assets that are available to satisfy current obligations or liabilities. The current ratios formula is current assets divided by current liabilities. The current ratio is basically dividing the components of the working capital, that is, the current assets and current liabilities. The first component of the current ratio formula is the current assets, the numerator. Current assets are the assets of an entity that are expected to be converted into cash or consumed within 1 year or the operating cycle, whichever is longer. Current assets include cash, marketable securities, accounts receivable, inventory, prepaid expenses, and other current assets. To easily memorize, the acronym CMAPIO can be used. The second component of the current ratio formula is the current liabilities, the denominator. Current liabilities are the liabilities of an entity which are expected to be settled within 1 year or the operating cycle, whichever is longer. Current liabilities include accounts payable, other short-term debt, accrued expenses, and the current portion of long-term debt. To easily memorize this acronym, ASAP may be used. For this acronym to be effective, we need to assume that other short-term debt includes all other current liabilities except for accounts payable, accrued expenses, and current portion of long-term debt such as unearned revenue, long-term liabilities that become payable on demand due to loan covenant violation or other current liabilities. Now, to compute for the current ratio of Liquidex Company, we need to compute for the two components of the current ratio formula, the current assets and the current liabilities. Current assets, remember, CMAPIO, will be computed starting with cash of $2,500,000 plus marketable securities of $2 million plus accounts receivable of $3,250,000 plus prepaid expenses of $750,000 plus inventory of $1,800,000 plus other current assets of $200,000 for a total of $10,500,000. The current liabilities, remember, ASAP, will be accounts payable of $1,400,000 plus short-term notes payable of $500,000 plus accrued expenses of $1,100,000 plus the current portion of bonds payable of $1 million. We will get the total current liabilities of $4 million. Substituting the amounts in the formula, that is $10,500,000 current assets divided by $4 million current liabilities, we will arrive at Liquidex's current ratio of 2.625 or approximately 2.63 interpretation. This current ratio will be used when compared to a benchmark, such as the company's prior year performance, competitors' performance, industry standard, and other reliable comparisons that are suitable for Liquidex Company. Generally, a current ratio of less than 1 indicates a liquidity problem. Although this does not mean bankruptcy, having a current ratio of less than 1 is detrimental to a company as it entails higher risk of falling short on current obligations. On the other hand, a current ratio of more than 1 is preferable. However, too high a current ratio may mean excessive investment in current assets that may be idle or yield only a minimal return. The second type of liquidity ratio is the quick ratio or the acid test ratio. The formula for computing the quick ratio is the quick assets divided by current liabilities. The quick ratio is more conservative than the current ratio because it includes only quick assets as its numerator. Quick assets are cash items and current assets that can be quickly converted into cash. The quick ratio has the same denominator as the current ratio, which is current liabilities. Based on IMA ratio definitions, quick assets consist of cash, marketable securities, and accounts receivable. To easily memorize, you can use the acronym CMA. It is important to remember that prepaid expenses, inventory, and other assets that cannot be quickly converted into cash are not included in the quick asset classification. Using the same financial information, let us compute for the quick ratio of LiquidX company. The difference between the formula of current ratio and the quick ratio is the numerator. In quick ratio, we just need to choose quick assets or assets that can be readily converted into cash. For LiquidX, the quick assets or CMA can be computed as the cash of $2,500,000 plus the marketable securities of $2 million plus the accounts receivable of $3,250,000 for a total of $7,750,000. As computed earlier, current liabilities amounted to $4 million. Therefore, we will arrive at a quick ratio by dividing the quick assets at $7,750,000 by current liabilities of $4 million. This is equal to 1.9375 or approximately 1.94. That's almost twice the company's current liabilities. The quick ratio indicates that LiquidX company can sufficiently liquidate assets to pay its current liabilities. While some companies believe that a quick ratio of at least 1 is a good sign of liquidity, we must bear in mind that this rule does not apply to all companies in all situations. Like the current ratio, too high a quick ratio may mean excessive investment in liquid assets, which either may be idle cash or investment in a low rate of return such as marketable securities, or entails additional costs, such as for accounts receivable. To reiterate, the adequacy of the quick ratio will depend on several factors, such as the nature or the industry in which the company operates. The third type of liquidity ratio is the cash ratio. Cash ratio is basically the ratio of cash and marketable securities over current liabilities. The cash ratio also has the same denominator as current ratio and quick ratio, which is current liabilities. The cash ratio is the most conservative liquidity ratio as it only considers cash and marketable securities in its numerator. Marketable securities are financial assets that are highly liquid and can be converted quickly into cash without a significant effect on prices. Marketable securities usually mature within a year from the date of purchase. Marketable securities include treasury bills, commercial paper, bankers' acceptances, and other money market instruments. To easily memorize, use the acronym CM. For this acronym, CM refers to cash and marketable securities. Let's go over the cash ratio of LiquidX company. The computation is relatively simple. Since we just need to add up cash of $2,500,000 and marketable securities of $2 million to get the total cash items of $4,500,000. Same as the current ratio and quick ratio, the denominator will be $4 million of current liabilities. Dividing the cash items of $4,500,000 by the current liabilities of $4 million, we will get a cash ratio of 1.125 or approximately 1.13. Similar to quick and current ratio, the adequacy of cash ratio will depend on several factors, which varies on a case-to-case basis or the industry in which the company operates. The fourth type of liquidity ratio is the cash flow ratio. To compute for the cash flow ratio, we just need to divide the company's operating cash flow over current liabilities. This ratio measures the availability of net cash provided by operating activities to settle current obligations. Unlike the current ratio, quick ratio, and cash ratio, the numerator of the cash flow ratio cannot be extracted from the balance sheet alone. The numerator, which is the company's operating cash flow, will come from the statement of cash flows. The operating cash flows is apparently those cash flows coming in and out from the company's main and central operations. These operating activities include buying and selling inventories, collecting receivables and paying salaries, accrued expenses, and the like. As with the other mentioned liquidity ratios earlier, the cash flow ratio's denominator is also the current liabilities, which makes it easier to memorize. Now let's go back to Liquidx Company's information and compute for the cash flow ratio. For simplicity, the operating cash flow was already provided, but in certain cases, you should compute for the cash flows from operating activities using the indirect method of cash flows. If you need to refresh on the formula, the computation can be referred to in Part 1, Section A, Financial Statements. So, we have an operating cash flow of $5 million and current liabilities of $4 million. Dividing the operating cash flow of $5 million by current liabilities of $4 million, we arrive at a cash flow ratio of 1.25. Again, the adequacy of cash flow ratio will vary depending on a case-by-case basis or the industry in which the company operates. Finally, the last type of liquidity ratio to be discussed in this video is the net working capital ratio. Net working capital ratio is the ratio of the company's working capital over current liabilities. It measures the level of net current resources, working capital, as measured against total assets. The net working capital ratio is a little bit different from all other liquidity ratios. The numerator of the net working capital is the difference of current assets and the current liabilities, or working capital, while the denominator of the ratio is the total assets. Essentially, the ratio measures the proportion of the working capital to total assets. Now, heading over to Liquidx information, we need the current ratio components, or the current assets, and the current liabilities for computing the numerator of the net working capital ratio. As previously computed, the current assets is equal to $10,500,000 and current liabilities is equal to $4 million. Subtracting the current assets of $10,500,000 from current liabilities of $4 million, we will get the working capital of $6,500,000. The denominator of the net working capital ratio, the total assets, is given amounting to $15 million. Therefore, our net working capital ratio will be $6,500,000 working capital divided by total assets of $15 million. 0.43 or 43%. Again, the adequacy of net working capital ratio will vary on a case-to-case basis as previously discussed. Liquidity ratios are mostly affected by the elements of current assets and current liabilities. Generally, increases in current assets, quick assets, cash items, and operating cash flows will increase liquidity ratios, while decreases on these items will also decrease liquidity ratios. Current liabilities is the denominator of all liquidity ratios except for the net working capital ratio. Increase in current liabilities, such as accounts payable, short-term notes payable, accrued expenses, and current portion of long-term debt, decreases in liquidity ratios. Current liabilities is the denominator of all liquidity ratios except for the net working capital ratio. Increase in current liabilities, such as accounts payable, short-term notes payable, accrued expenses, and current portion of long-term debt, decreases liquidity ratios. To summarize the effects of the changes of components of liquidity, the table below is a great reference. I suggest that you pause the video for a moment to understand and analyze the table. You may also copy these into your index card or notes for future reference. In the third column, for example, when current assets, or the CMA PIO, increase, the current ratio also increases and vice versa. When current liabilities increase, however, current ratio decreases, vice versa as well. In the fourth column, the changes and the accompanying effect were basically the same as the current ratio, except that changes in prepaid expenses, inventory, and other current assets that cannot be quickly converted into cash, or the PIO, have no effect on the quick ratio. In the fifth column, the changes and the accompanying effect were basically the same as the current ratio and quick ratio, except that the changes in accounts receivable, prepaid expenses, inventory, and other current assets, or the APIO, have no effect on the cash ratio. In the sixth column, changes in cash was labeled as NA. The effect cannot be determined because the cash flow's numerator is operating cash flow, but the change in cash may come from three different sources: operating, financing, or investing activities. We can also notice the changes in current assets has a reverse effect on cash flow ratio. Remember, in computing the cash from operating activities under the indirect method of cash flow preparation, increases in current assets are deducted from net income, while decreases in current assets are added to net income, while increases in current liabilities are added in net income and decreases in current liabilities are deducted from net income to arrive at the operating cash flow. In the last column, we can notice that the changes and the effect is the same as the changes and the effect on the current ratio. This is because the net working capital has the same components as the current ratio, the current assets and the current liabilities, except that the denominator is the total assets. Now, let's have a recap. How do we define liquidity? Liquidity is the ability of a company to pay short-term obligations or current liabilities as they fall due. And what are the 5 general types of liquidity ratios? Yes, we have the current ratio and the quick ratio, or the acid test ratio. Cash ratio, cash flow ratio, and the net working capital ratio. To help you with memorizing the formulas of each liquidity ratio, we have created a basic formula guide. Basically, this guide is a summary of all formulas and acronyms we discussed earlier. Let's try out how this works. For current ratio, for example, the numerator is current assets and the denominator is current liabilities. Shortening it would be CA over CL, while expanded version would be CMAPIO over ASAP. The same goes to quick assets, cash ratio, cash flow ratio, and net working capital ratio. But for the net working capital ratio, you may notice that the denominator, the total assets, is different from all other liquidity ratios. I suggest you pause this video to write down the formula guide in your index cards or notes before proceeding to the practice questions. Thanks. As a note, you are going to be quizzed right after this video lecture ends. Applying what you have learned immediately will help you retain information faster. You can find the quiz right below the video. Please go through it before proceeding to the next topic. Congratulations on completing this lecture. You're now one step closer to becoming a CMA.